Hi, I'd like to give you a brief introduction to XPD Soccer Group. It's listed on the Australian Stock Exchange under the ticker XPD, but all of its operations are in mainland China. It's a small clothing manufacturer with an enterprise value of about $20 million, and its share price has fallen from about 15 cents a year ago to 10 cents today. It's now trading on a forward EBITDA multiple of only 0.5 times, which is below where it's been in the past and far below other clothing manufacturers. It's also trading at a sizable discount to the 69-cent valuation on Shareclarity. So XPD designs and manufactures footwear, mostly soccer boots, that it sells online into sporting goods stores across China. It owns and operates its own factories and outsources some of its manufacturing to external suppliers. What intrigues me most about the business is its share price, which by all measures is particularly low. When I went through the valuation on Shareclarity, I couldn't see any majorly aggressive or contentious revenue or earnings forecasts, which are also in line with guidance. What did strike me, however, is its cost of capital, which had an additional 5% added to account for the perceived risks of operating in China, but more importantly, being able to expatriate capital out of China to its Australian shareholders. So this is restricted by two things. Firstly, a business is required to maintain a minimum cash balance before it's able to pay dividends, which XPD already has. And secondly, a business is requires approval from the central bank to transfer money internationally, which XPD has not yet received. And this obviously therefore goes to value, but the interesting question for me is what would be an appropriate cost of capital for a business like this? In the most elemental terms, a bank typically charges interest of between 20 and 30% on a personal credit card. If I raise the cost of capital to these levels for XPD, its valuation would still be 3 times what it is today. So is that a risk worth taking?